So, have you ever caught yourself wondering why, no matter how incredibly diligently you save your money, you never quite seem to build actual life-changing wealth? I mean, it's super frustrating, right? You do all the right things, you put money aside every month, and the needle, it just barely moves. Well, what if the core problem isn't your discipline at all, but rather the entire foundation of how you view money in the first place? Welcome to this explainer. Today, we're going to completely deconstruct the journey to financial freedom by building what we're going to call the wealth pyramid. We're going to take you from a really basic everyday spending mindset all the way up to advanced long-term investing strategies. It's like a giant puzzle, and we're putting the pieces together. Okay, let's dive right in. Here is our quick 4-step game plan. First, the foundation of mindset. Second, the engine of income and savings. Third, the mechanism of transitioning from just saving to actual investing. And finally, the vehicle, where we'll compare dividends and index funds. All right, let's hit step 1. Step 1, the foundation. To totally reset our mindset, we are going to look at the Japanese rules of financial discipline. Just look at this staggering $11,000 figure. That is the credit card debt sitting on the shoulders of the average American household right now. Meanwhile, the average Japanese household, they carry almost none. And the sources point out this isn't because of government policy or massive income differences. It's actually because of deeply baked, unwritten cultural rules that most Japanese people just follow on autopilot. The first rule is this really interesting concept called Giri, which essentially translates to obligation. You see, in American culture, we tend to treat debt as just a convenient financial tool. You finance a new couch at 0% and literally think nothing of it. Well, until you're still paying for it 3 years later anyway. But with Giri, debt is treated as a heavy moral weight. Owing someone money feels physically uncomfortable. It's seen as a burden on your character. Because of this mindset, the Japanese default is just to pay in full. They simply refuse to carry a weight they don't absolutely have to carry. Next up, we have Soroban, which is the Japanese abacus. Now, kids learn this super early, but it is not just some quirky math hobby. Training on an abacus actually rewires your brain to make numbers spatial and visual. You stop needing a calculator because you start doing this complex math right in your head. And when you internalize math this way, spending becomes incredibly real, and you instantly calculate opportunity costs before you ever swipe your card. Let's look at Broke Brian, for example. He operates purely on reflex. He sees a $120 jacket, gets a quick hit of dopamine, and just buys it, even if he doesn't really need it. But then you have Smart Sam. Using that internalized Soroban math, Sam sees the exact same price tag, but he instantly calculates that it costs him 8 hours of after-tax work, or say 12 months of compound growth in an index fund. Spending suddenly transforms into a highly conscious decision, not just an impulse. The sources also outline this brilliantly simple system of resourcefulness that completely replaces our habit of pure consumption. It starts with mitate and furoshiki, repurposing things you already have and finding infinite uses for everyday items, rather than buying a separate gadget for literally every single problem. Then there's osagari, which is utilizing the hand-me-down economy without any ego, saving massive amounts on family expenses. Add to that Nadan Ishiki, memorizing baseline store prices so you're never fooled by those fake sales. And uchimizu, which is the habit of always trying the free solution first, like simply drinking a glass of water before reaching for a snack. And to tie the whole shebang together, you have Mujin, community-based savings circles built purely on trust, completely bypassing bank fees. Okay, but mindset is just the foundation. Let's move up to the next level of our pyramid, the engine. This is where we focus on realistic 5-year strategies to build some serious economic momentum. I absolutely love this vivid quote from the sources. Saving money alone is like trying to fill a swimming pool using a teaspoon. Think about it. If you're only putting away a few $100 a month, sure, you're making good choices, but you are not going to become wealthy quickly. Saving is solid, for sure, but increasing your income horsepower is the true driver of wealth early in your journey. But, and this is a huge but, increasing your income comes with a massive psychological trap called hedonic adaptation. This is the reality where your brain just rapidly gets used to lifestyle upgrades. You know how it goes. You get a raise, so you buy a better car, you get a much nicer apartment, and suddenly all that new money is completely gone. If you let this trap inflate your lifestyle, you will stay broke no matter how high your income climbs. So here is the realistic blueprint to build unstoppable momentum over 5 years. First, radically increase your earning power through new skills or switching jobs. But to actually beat hedonic adaptation, you absolutely must do step 2. Save half of every single raise. If you get a $1,000 bump in pay, automatically invest 500 of it and then enjoy the rest. Put that money to work and stay intensely consistent for 5 years to let that compounding momentum really take off. And that brings us to step 3, the mechanism. We really need to tackle the psychological hurdle of taking your hard-earned cash out of safe savings and putting it to work in the stock market. The mathematical necessity of investing here is honestly jaw-dropping. Just look at the difference. Leaving $10,000 in a standard savings account at roughly 1% for 20 years, it leaves you with just over $12,000. But investing that same amount at a historical 10% average return grows it to roughly $67,000. Saving money is a lot like storing seeds in a glass jar. Yeah, they're safe, but absolutely nothing grows. Investing is taking those seeds and finally planting them in the soil. Now, the main reason people don't invest is simply the fear of volatility. It's scary, but the crucial mental trick to beat this anxiety is splitting your money into 2 totally distinct buckets. You have your safety money, which never, ever moves. It protects you from life's emergencies, so you never have to panic sell. Then you have your growth money. This money's one and only job is to grow, which means you absolutely must allow it to fluctuate. So, to smoothly transition from a saver to an investor, lock in that 3 to 6 month emergency fund first. Once that safety net is built and you've made that mental separation, just start small. Honestly, even $50 builds the habit. Then buy simple whole market index funds. You do not need to day trade or pick single stocks. Owning the whole market is a wonderfully boring yet incredibly powerful strategy. All right, let's move to the final peak of our wealth pyramid, the vehicle. Once you're ready to invest that growth money, you have to choose a path: index funds or dividend investing. Let's impartially break down the core differences between these 2 fantastic approaches. Index funds offer incredible broad diversification and extremely low fees. However, psychologically, they can be super tough. During a market crash, watching your account balance drop with no income stream coming in feels pretty brutal. On the flip side, we have dividend investing. The primary benefit here is that companies actually pay you cash directly. You get income without ever having to sell a single share. Psychologically, this provides a massive amount of reassurance during market downturns because that cash flow usually remains pretty stable. The downside, though, you're often much less diversified. Let's put some real numbers to this. Say your goal is $50,000 a year in retirement income. The dividend path requires you to have about $1.4 million invested at a realistic 3.5% yield. Now, the index fund path requires slightly less capital, around $1.25 million, utilizing the famous 4% withdrawal rule. So the index path might require less money upfront and generally offers faster overall growth, but it demands the psychological toughness of selling off your shares to generate cash, even when the market is tanking. Ultimately, the best strategy is simply the one you can stick with emotionally. Well, we've definitely covered a lot of ground today, from ancient Japanese cultural habits all the way to the math of compound interest. But it really all boils down to one simple question. 5 years from today is going to arrive whether you prepare for it or not. The choices you make right now, to respect the weight of debt, to save half of your next raise, and to finally plant your seeds in the market soil, will entirely dictate your answer. So, will you still feel financially stuck in 5 years, or will you use these tools to completely alter your financial destiny? The choice is entirely up to you.